Dirty dealings, corporate battles, consumer woes. This is Evening 5. Bursa Malaysia and the Securities Commission today jointly pledged to cut approval time to 3 months for both main market and ACE market listings. The sped-up approvals are applicable to new initial public offering applications received from March 1st, the SC and Bursa Malaysia said in a joint statement. The commitment, however, will be premised on advisors or sponsors satisfactorily addressing the regulator's queries and comments within 5 market days. Bursa Malaysia CEO Datuk Muhammad Umar Swift said the more competitive time to market will enhance the exchange's attractiveness to companies seeking to list in Malaysia. The time frame would be able to cater to the dynamic business needs of companies looking to raise funds in the capital market as part of our ongoing efforts to remain competitive and relevant for both local and international investors, according to SC Chairman Datuk Sri Dr. Awang Adik Hussein. The commitment tops current practice since 2021 of issuing queries and comments within 10 market days following a complete IPO application, as well as issuing subsequent queries and comments within 5 market days to each response round. Bursa Malaysia is the sole approving authority for IPOs on the secondary market, the ACE market, while a main market listing would still require the approvals of both Bursa and the SC. The regulator said they will continue to maintain rigour in the assessment to avoid compromising investors' protection and public interests. FGV Holdings FY2023 net profit plummeted 12-fold to 103 million from 1.33 billion previously as earnings from the plantation business plunged amid lower average crude palm oil prices. Revenue for the year also declined 24% year-on-year to 19.36 billion ringgit. Average CPO prices fell to 3,901 per tonne from 4,832 per tonne in FY2022. The weaker numbers were also further exacerbated by a 29% increase in CPO production costs ex-mill. Meanwhile, the decrease in the plantation sector's profitability was offset by improved profitability in the logistics and other sectors, coupled with reduced losses in the sugar sector. FGV declared a final dividend of 3 cents per share, amounting to a payout of 109.44 million for FY2023. For its fourth quarter, FGV saw a fourfold drop in net profit to 71.83 million, while top line declined 12% year-on-year to 5.36 billion from 6.1 billion previously. FGV says that it anticipates a satisfactory performance for FY 2024 and expects CPO prices to range between 3,900 and 4,200 per tonne, premised on the B35 biodiesel mandate in Indonesia, weak demand from major importing countries and price competition from rapeseed and sunflower oils. FGV said that in the coming quarters, its plantation sector foresees a slight increase in fresh fruit bunch production and yield as the labour supply recovers and improved estate costs driven by lower fertilizer and energy costs. A one-off tax credit lifted AMMB Holdings' net profit for its third quarter by 22.3% year-on-year to 543.4 million ringgit. However, revenue for the quarter decreased by 5.83% to 1.15 billion from 1.22 billion previously. AMMB booked a one-off tax credit of 537.6 million as well as 435.3 million in allowances for impairment on loans, advances and financing. On a cumulative basis, net interest income fell by 8.7% to 2.48 billion, but this was partially offset by a strong growth of 19.2% in non-interest income to 995.8 million ringgit. In a statement, Group CEO Jamie Ling said the group maintained its return on equity at 10%. He adds that the bank took steps to increase its loan loss coverage to 100% for the individual retail segment as a prudent buffer, and the further strengthening of capital ratios means that AMMB is on track to revert to its historical dividend payout trend. Looking ahead, AMMB maintains its optimistic stance on its FY 2024 prospects, supported by resilient domestic demand and the expected recovery in external demand. AMMB says that it remains committed in ensuring its FY 2021 to 2024 Focus 8 strategy ends on a high note by focusing on driving sustainable revenue growth, maintaining cost discipline, improving asset quality, ensuring a healthy liquidity position, and strengthening capital levels further. Petronas Chemical Group's net profit for the FY2023 plunged 73% year-on-year to 1.69 billion from 6.32 billion against a backdrop of a volatile chemicals market and interruptions at its plants. Revenue for the year dipped 1% to 28.7 billion ringgit. For its fourth quarter, PetChem's net profit fell 76% year-on-year to 112 million on the back of revenue of 7.21 billion versus 8.7 billion a year earlier. PetChem declared a dividend of 5 cents per share, which brings total dividends for FY 2023 to 41 cents per share. In a statement, PetChem Managing Director cum CEO Mazwin Ismail said that while FY 2023 was a tough year for the group, both on the market and operational fronts, it managed to remain resilient with a healthy financial position. On its outlook, Mazwin said the challenges seen in 2023 are expected to continue into 2024 as economic recovery is expected to remain sluggish, but with pockets of opportunities in various sectors. He adds that the chemicals industry is cyclical in nature, and as such, PetChem expects the current down cycle will turn as demand catches up with supply. Cahya Mata Sarawak's fourth quarter net profit spiked 71% year-on-year to 36.3 million as the group's cement segment returned to profitability. Revenue for the quarter rose 7.86% year-on-year to 332.7 million according to the boss filing. CMS proposed a first and final dividend of 2 cents per share. However, for its full-year report card, CMS's net profit more than halved to 115.1 million from 287.1 million, mainly as the group recognised a one-off gain of 197.8 million in FY 2022. In contrast, FY 2023 top line rose 90% year-on-year to 1.2 billion on the back of higher contributions from its cement and oil tools divisions. Looking to FY 2024, CMS said key challenges ahead consist of the ringgit versus the US dollar exchange rate, as well as the outcome of its ongoing arbitration concerning Cahya Mata phosphates. CMS said that aside from those challenges and barring any other unforeseen circumstances, the group is cautiously optimistic of the prospects for 2024.